Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
Markets are forward-looking, which is impressive because most of us struggle to look past lunch. It's priced in is the financial equivalent of trust me, which historically has never ended well. Deadline, a flexible suggestion until it becomes a crisis. Optimization, making something faster so it can fail more efficiently. I deserve this, has funded more bad financial decisions than any recession.
The IMF hasn't changed numbers much, but it's changed the language. Baseline is out, reference forecast is in. As economists speak for, we are less sure than we used to be. Global growth takes along around 3%. The real story is divergence. The US holds up, Europe drags, China slows, and India still does the heavy lifting. Emerging markets carry the pace, but even there, momentum isn't uniform. This is not a synchronized recovery, it's a patchwork economy where geography increasingly decides destiny. And when the IMF starts hedging its vocabulary, it's usually because the world isn't following the script. Prediction markets are quietly backing off the political thriller. Odds of Powell exiting by May have dropped by just 31%, while Kevin Walsh's chances of stepping in are sliding to fresh lows around 40%. Translation: the market flirted with regime change, but then remembered how central banks actually work. Leadership transactions at the Fed aren't exactly buy now, decide later. This repricing signals fading urgency around policy disruption. Traders are dialing down the possibility of a sudden pivot driven by personnel and refocusing on the usual suspects: data, inflation, and rates. Global debt has quietly climbed to $348 trillion, up a third in just 6 years. That's not a cycle, that's a habit. And unlike past expansions, this one comes with far less room to respond when things go wrong. The world has used up a lot of its crisis fighting capacity before the next crisis even arrives. High debt means tighter policy options, slower responses, and a much more smaller margin for error. Markets may tolerate debt, they just don't tolerate surprises when it matters. As Herbert Stein said, if something cannot go on forever, it will stop. Japan is often used as the ultimate cautionary tale. Invest and wait 30 years for nothing. But the data tells a more inconvenient story. With near zero inflation, SIP investors in Japan have delivered real returns comparable to India over the same period. The problem wasn't the market, it was expectations. Lump sum at the peak, painful. Stay disciplined with regular investing, quietly effective. This flips the narrative. Markets don't fail investors nearly as often as investors fail their own time horizon. Consistency, not brilliance, tends to do the heavy lifting. Goldman's base case reads like a carefully engineered rally. Start at $4,450, add a dash of speculative normalization, sprinkle in Fed cuts, and then boom, central banks show up buying 60 tons a month like it's wholesale clearance sale. That last leg does the heavy lifting, pushing gold price towards $5,400 by end 2026. This is Goldman's base case scenario. What's really doing the work here isn't just rates, it's persistent sovereign demand. Translation: when central banks keep stacking, they quietly put a floor under prices and occasionally a rocket under momentum. If anything derails this, it's not retail sentiment, it's policy surprises or a pause in official buying. Until then, gold is not just a hedge, it's got institutional sponsorship. Here's the oddity: oil is high, supply is tight, geopolitics is noisy, and dealmakers are unusually quiet. Historically, this is when CEOs start buying assets like they're on sale. This time they're holding cash like it's oxygen. The signal is clear: uncertainty is trumping opportunity. Between political risk, balance sheet caution, and fragile supply chains, the industry isn't chasing growth, it's avoiding regret. And that's a shift. High prices used to trigger ambition. Now they trigger hesitation.